Meta just dropped its latest earnings bomb, and the headlines looked ugly. The stock dropped as much as 9% after the numbers hit the wire. But here is the truth behind the chaos. Meta's actual business is on fire, but investors are terrified of how much money they plan to spend on artificial intelligence. The biggest shocker was the earnings per share, which officially came in at just $1.05. That number was down a massive 83% from last year, and net income plunged to $2.7 billion. So, what gives? This massive drop was due to one gigantic non cash income tax charge of nearly $16 billion. This charge came from the implementation of what the company called the One Big Beautiful Bill Act. The good news is that the company expects this same law to significantly reduce its federal cash tax payments for years to come. If you ignore that one-time accounting charge, Meta's adjusted earnings per share would have been $7.25. That number easily crushed what Wall Street analysts were expecting. The company is still making serious bank on its core business. Revenue soared to a record $51.2 billion, jumping 26% year over year. That is the fastest revenue growth Meta has seen in over a year. The advertising business drove the success, with ad impressions up 14% and the average price per ad climbing 10%. People are still flocking to the apps. The number of daily active users across Facebook, Instagram, and WhatsApp grew 8% to 3.5 billion people. Plus, Instagram just hit a massive milestone, 3 billion monthly active users. But here's why the stock still got hammered. Meta is preparing to spend an obscene amount of money on artificial intelligence. The company raised its outlook for capital expenditures this year to between $70 billion and $72 billion. This huge spend goes toward building the compute power and data centers needed for artificial intelligence. Even more worrying for some investors, Meta said its spending will be notably larger in dollar terms next year than it is this year. Overall expenses are also expected to grow significantly faster in 2026, driven by infrastructure costs and compensation for top AI talent. Mark Zuckerberg is aggressively defending the massive outlay. He believes the company must front-load capacity now to be ready for the goal of superintelligence. If it takes longer to achieve, he says the extra computing power will still be used to improve the core business, making the investment profitable over time. Investors are also keeping a sharp eye on the metaverse division Reality Labs, which continues to bleed money. The unit posted an operating loss of $4.4 billion last quarter. Since late 2020, Reality Labs has racked up cumulative losses exceeding $70 billion. However, one bright spot is the new AI glasses, which sold out in most stores within 48 hours of launch, showing strong demand. Ultimately, Meta delivered strong underlying results and revenue growth, but the market is anxious about the unprecedented level of spending planned for the AI race. The company is taking a huge long-term gamble, and investors are reacting to the short-term cost. If you want to keep up with the biggest moves in the market, make sure you hit the like button on this video, and don't forget to subscribe and ring the notification bell so you don't miss our next breakdown. I'll see you soon.